Last week, we started operating statements, and then we were able to dissect all relevant principles or concepts in relation to operating statements. And I promised you that today we are just going to be doing calculation. Of course, it is expected that during the week, between our last class and now, there are new students that will join us. So the onus is on me to just, for some minutes, to recap what we did in our last class. That will also benefit those that join the class as well to remember some of the things that we discussed in the class. All right. Thereafter, then we begin to solve questions. I have just 2 questions to solve with you. Then you are going to do one as an assignment. All right. So last week we started with operating statements, and we said that operating statements is also known as income statements, and it is a statement that shows the operating performance or results of an organization at a specified period, for a specified period. It can be, the period can be monthly, right, quarterly, biannually, or yearly. Okay. Then we talk about methods of presenting income statements. Basically, we have 2 methods of preparing income statements. One is marginal costing approach, then 2, absorption costing approach. We started with the marginal costing approach. We said that it is a technique that charges the total variable cost of production, including direct material, direct labor, direct expenses, and variable part of production to the unit cost of a product. We also mentioned that marginal costing technique is an accounting system whereby the period costs incurred are written off fully from the aggregate contribution. Not only that, we said that marginal costing technique is designed principally to aid managerial decision. Why? Because the technique will allow management to focus on the areas of the business that are critical to achieving the organization's objective. Then I gave you the key points or features of marginal costing technique. The first one is that using marginal costing technique, opening and closing stocks are valued at total variable cost per unit. Then 2, we said that under marginal costing concepts, fixed production overhead is not part of production cost, but rather it is written off fully from the aggregate contribution. Okay. All right. Then 3, we said that under marginal costing approach, fixed costs and fixed production overhead are costs that have no sympathy for activity level, meaning that irrespective of the activity level, irrespective of the production volume, irrespective of the number of units produced, the fixed production overhead will remain constant. Why? Because it is based on the budgeted output. That is, to calculate fixed production overhead under the marginal costing approach, just multiply the budgeted output with the fixed overhead absorption rate. So that will give you the fixed production overhead that you are going to use under the marginal costing approach. The point number 4 is that marginal costing technique does not recognize absorption costing. It doesn't recognize absorption costing. Then the last one is that marginal costing uses contribution, unlike absorption that uses gross profit. When we finish discussing that, but I now gave you I explained the format which you are going to use to present the income statement. Thereafter, we'll move to discussing absorption costing method. We said that absorption costing method is a technique that charges the total cost of production, including variable costs and then the fixed production overhead to the unit cost of a product. And we also mentioned that absorption costing is a technique that relies heavily on the generally accepted accounting principles for external reporting purposes. Okay, so we then move on to discuss the points or the features that you need to consider when you are preparing the income statement using the absorption costing method. The first is that opening and closing stocks are valued at total cost per unit. Then point number two, fixed production overhead is part of production cost. Point number three, absorption costing method uses gross profit, unlike the marginal costing method that uses the contribution margin. Then the last point that we made under the absorption costing is that, of course, absorption costing recognizes overhead absorption. Okay, it recognizes overhead absorption. These are the 4 points we mentioned under the absorption costing approach. Then I explained the format that you can use to prepare your income statement, then using the absorption costing method. All right. Then we don't talk about the reconciliation statement. Why do you need to talk about reconciliation statement? Because the income statement prepared using the marginal and absorption costing approach will not produce the same results. The net profit or loss under each technique will be different. What is causing the difference is supposed to be equal. Of course, we then go ahead to explain what is causing the difference. We said that the major causes of difference between the performance, between the operating performance using marginal costing and absorption costing is due to the method of valuing stock, because marginal costing approach value stocks using the total variable cost per unit. Total variable cost per unit, whereas absorption costing value opening and closing stocks using the total cost per unit. We then said that the variance arising from the difference in profit between the two techniques can be reconciled using the reconciliation statement. And I also demonstrated how you can determine the difference in profit and difference in stock valuation using the two techniques. And I mentioned that once the difference in profit before tax equal difference in stock valuation, that means all what you have done is perfectly okay. With this, you can easily pocket 15 marks or 20 marks, depending on the marks awarded for the question. Then lastly, we also demonstrated how to calculate closing stock, because I mentioned to you that examiner will never give to you the closing stock. You are the one that will estimate the closing stock under the two techniques. So the last point that we mentioned was overhead absorption costing. We said that overhead absorption costing represents the process of allocating indirect costs to a product or service. And we also mentioned that when the budgeted overhead equal to the overhead absorbed to product, it means that the overhead is appropriately or correctly absorbed. Okay, but where the budgeted overhead is different from the overhead absorbed to product, this may result in under or over absorption. We then explain what is under absorption, what is over absorption, how do you treat under absorption, how do you treat over absorption. Okay, all of this we discussed in our last class, and this is where we stopped. So briefly, that is what we did last time. Today, we are going to have illustration. So before we begin to read the question, let me know if you have any question. For those of you that were in class last week, let me know if you have any question based on what we discussed last time before we begin to solve question. If not, we move ahead and we'll start with a question quickly so that we can, within the next few hours, we are done. Okay? All right. So please, I believe all of you already have access to the recording of our last class. I will advise you to go ahead, go and complete your notes, go and form your notes based on what we discussed in the class last time. All right, so that you don't accumulate notes. You have to ensure that you are at par with the class. In fact, you should be ahead of the class. Okay. So we are not going to solve more than 2 questions because it usually takes time. It takes time to question under operating statement takes time to solve because you are going to have more than one period usually. So let me see. I've never solved this illustration number 1 in the class. I've been given it as an assignment. Maybe I should just, this one has 3 periods. That's one of the reasons why I was avoiding it because of the 3 periods. It will take time. In any case, let's go through it together. Let me see. Then after that, then we solve illustration number 2. Then I will give you illustration number 3 as an assignment. You are going to do, I'm telling you now, you are going to do illustration number 3, Panama Limited. This is an assignment for you. So it's an assignment for you. Make sure you attempt it. All right. So that is that. So let me read the first one. I need you to open to the material at your end. All of you, I believe you have access to the material. If you don't have access, then you can ask from the PM group. One of you will share. Okay. Yes. The budget. No, I've not heard anything from you guys. Let me know. Is anybody hearing me? Joseph, your mic is on. You are speak to me. Joseph. Yakubu,
We are
Idris,
hearing you,
speak to
sir.
me. Okay, then.
We are
Thank you.
hearing you,
You
sir.
can now mute. All right, thank
Sir,
you.
we can
Mute.
hear you. We can hear you, sir.
All right, then. Thank you. Mute yourself. All right. The budget of Shakara Limited provides for the manufacture and sale of 10,000 units of local caps per month. The unit standard cost is 12 naira, made up as follows. All figures assumed to be accurate. The selling price of the cap is 16 naira. The production and sales for period 1, 2, and 3 are as follows. So we are given the units produced for period 1, 2, and 3. The sales units, please ignore this. This is not sales value. This one should be in units. It's an error. The sales units were also given for period 1, 2, and 3. Production can be increased to 11,000 units without a corresponding increase in fixed overhead. Only you are required to A, prepare operating statements for the 3 periods, assuming the company uses absorption costing and marginal costing. B, comment on the difference of the 2 systems as regards 1, stock valuation, and then period profit. Okay, so that is that. That is what examiner wants you to do. So in this question, we want to solve. We want to prepare operating statements using the absorption and then the marginal costing. Let me switch to the working note so that together we can solve the question. Okay. All right. This is solution. So illustration 1. Page, what page is that? I think page 19. No, page 18. Okay, page 18. All right. So the name of the company is Shakara Limited.
And I. Did you work them already?
What are you asked to do? You are to prepare operating statements using the absorption costing approach. All right. So I will then come here. A Roman figure 1. Operating statements. That's what examiner call it.
Correct, but you know what? Not a fan.
Using absorption costing method. Well done. That person that is making noise, Mansour.
Be on brand for my life.
Well done. Since the examiner did not call it method, approach, concept, or technique, I can use anyone. Let me use ACA. All right. So because we have 3 periods, I'm going to create 6 different columns. So period 1, here will be period 1, period 2, then period 3. Okay. Then each period will be divided into 3. Sorry, into 2. Because I don't know the extent my table will take, let me just do, like this. I'm going to put this one a little bit to the front. Okay. Now, each period will be divided into 2 to account for credit and debits. All right, that's it. Okay, so instead of me to be putting error sign under each column, I can come here to say, I want to restrict my number to thousands. If you want to do millions, it's the same thing. Now, based on the formats, the first item will be the sales value. So here will be sales. How do you determine the sales? Very simple. Just multiply the units sold with the selling price per unit. So in the first period, how many units were sold? Let me look at you. I need somebody to be my partner. Let me look at you. Anyone with clear voice and stable internet should be my partner for tonight in this question. Let me see. Yes, who wants to help me? Who will be giving me number among you? Okay, let's start with Christiana. Christiana, are you ready for me? Christy, are you ready to be my partner so that you can give me numbers? Gloria, are you ready for me? So now it comes to giving me figures. All of you, okay, Gloria. Yeah. So you'll be my partner on this question. You'll be supplying me with numbers, both calculations and then picking number from the question. So let's start. We want to determine sales value. How do you calculate sales value? I said just multiply the sales units with the selling price per unit. So in the first period, Gloria, it's like your background. There is nothing with your background. Let's avoid that. Okay. It's like, who has a perfect environment where there is no noise? Chidera, you want to try? Chidera.
Yes, I'm here.
Okay. Please, bring out your calculator. We want to determine sales value. For the first period, 8,000 units multiplied by selling price. Selling price in the question is 16 naira. So 8,000 multiplied by 16 naira. What do you get?
We have 128,000.
128,000. Since our figures are in thousand, I will just put 128. Immediately after the sales, we need to determine the production cost. So I will then come here, production cost. When you are determining your production cost, the first item will be the opening stock. Whether you are given opening stock or not, you have to indicate it, particularly where you are given more than one period. Opening stock. Remember, we are using assumption costing approach, and under the assumption costing approach, we said that opening and closing stocks are valued at total cost per unit. So let's go to the question if we are given any opening stock. In the question, are we given opening stock? So we are not given any opening stock. Okay, we are not given any opening stock. So that means just put a dash. So here will be dash. Let's move a bit faster. After opening stock, sorry, I wrote operating instead of opening. After opening stock, the next item will then be the direct material. I will go to the question to go and check if I'm given direct material. Okay, in the question, the cost per unit, the standard cost, we have direct material, direct labor, and then variable overhead and fixed overhead. So I can come here to say direct material. Let's shorten it. We're also given direct labor. There is no direct expenses in the question, so but we have variable overhead. We also have fixed overhead because we are using assumption. So fixed overhead is part of production cost. So let's then go back to the question. Yes, we want to determine direct material cost. We want to determine direct material cost. So the direct material per unit is 5 naira. How many units were produced in the first period? The company produced 10,000 units in the first period. Therefore, 10,000 multiplied by 5 naira will give us 50,000.
50,000.
Okay. Then under direct labor, what is direct labor per unit?
2 naira.
Pardon?
2 naira.
I don't want to be switching pages. That's what I called my partner. 2 naira multiplied by the unit produced, which is 10,000. That's 20,000 naira. So here will be 20. Variable overhead. How much is variable overhead per unit?
1
1 naira.
1.
1 naira multiplied by 10,000 units will give
10,000.
us 10,000. Then, of course, because we are using assumption costing approach, fixed overhead is part of production cost. Therefore, how much is fixed production overhead per unit? That is your fixed overhead absorption rate.
4 naira.
We are given, which is 4 naira. 4 multiplied by 10,000 units will give us 40,000. Okay, then you add up. So what's the total? 70, 80, 120,000. So this represents cost of goods available for sales. Immediately after the cost of goods available for sales, you are supposed to deduct closing stocks. Remember, this is a format we are following. So I will then say closing stock. Working number one. So I mentioned to you last week, I also repeated it earlier today. Closing stocks will never be given to you. You are the one that will estimate by yourself. Therefore, let's go and calculate closing stock. This first page is for absorption. The second page is for marginal. The third page is for reconciliation. Then the fourth page will be for our workings. Working number one, closing stock. So we have three different periods. So we do for period one, period two, and then period three. So the first item will be when you are calculating your closing stock. Closing stock is opening stock plus actual unit produced less units sold. That will give you closing stock. So here is opening stock. Opening stock in the first period is nil. We are not given opening stock. So actual production. In the first period, 10,000 units were produced. Here is 10,000. Therefore, add it to the opening stock. That will give us 10,000. So this represents the total units available for sales. So after the total units, you need to less the units sold. In the first period, how many units were sold out of these 10,000 units? My partner, are you
8,000.
sleeping?
8,000.
8,000 units were sold. 8,000 units were sold. 8,000 minus 10,000 will give us
2,000.
2,000. So the closing stock in the first period is 2,000 units. Let me complete my table once and for all. So this is closing stock in units. So let's complete for other periods. The closing stock in the first period will become opening stock in the second period. Therefore, 2,000 units were unsold in the first period. It will now become opening stock at the beginning of the second period. So here will be 2,000 units. How many units were produced in the second period?
1,000, sir.
8,000
8,000.
units.
8,000 plus 2,000 will give us 10,000. So in the second period, how many units were sold?
9,000.
1,000.
Did you say 9,000?
Yes, Yes, 9,000, sir. 9,000.
Yes.
9,000. Minus 10,000 will give us 1,000. So the unit unsold in the second period is 1,000. That will become opening stock at the beginning of period 3. So here is 1,000. How many units were produced in the third period?
11,000.
11,000.
11,000 units. Plus 1,000 will give us 12,000 units. How many units were sold in the third
12,000.
period?
12,000.
12,000 units. So that means there is no closing stock at the end of period 3. Now that we have calculated, we have determined the closing stock in units, we need to value the closing stock. It then say valuation. We have 3 different periods. In period 1, under ACA, and then MCA. To determine your valuation, it will be units unsold multiplied by cost per unit. You know, when you are using ACA under absorption, we said stock are valued at total cost per unit. Therefore, in period 1, this closing stock is 2,000 units. Multiplied by the cost per unit. What's total cost per unit? Which is 12 naira. Therefore, what do you have here?
24,000.
2,000 multiplied by 12. That's
24,000.
24,000, right?
24,000.
So
Yes.
under ACA, in period 1, under ACA, our closing stock is equal to 24,000. Under the MCA is the same 2,000 units. Multiplied by, when you are using marginal costing approach, stocks are valued at total variable cost per unit. If total cost, that is standard cost, is 12 naira per unit, and fixed overhead assumption rate is 4 naira, so 4 minus 12 will give us variable cost of 8 naira. So here we multiply by 8. So give it to me. 8 multiplied by 2,000 will give us 16,000 naira. So we are done with period 1. We then move to period 2. The same thing. ACA, MCA. In period 2, closing stock is 1,000 units. Multiplied by 12 naira. That's 12,000. 1,000 units. Multiplied by 8 naira. Equal to 8,000. Then period 3. In period 3, we don't have closing stock. Therefore, you ignore. Okay? You ignore. Okay, let me rewrite this so that you understand what we're trying to do. Here is, instead of saying units multiplied by cost per unit, let's say unit multiplied by total cost per unit, or total variable cost per unit. Okay, depending on whether you are using ACA or MCA. Okay. So now that we have computed our closing stock in the first period under ACA to be 24,000. So let's go and post. So here is 24. The minus. So 24 minus 120 minus 24. will give us 96,000. What do we call this 96,000?
Cost of goods sold.
Yes. Cost of goods sold. Thank you. After cost of goods sold, remember, we are using absorption costing technique. Immediately after the cost of goods sold, you are supposed to adjust for overhead assumptions. You are supposed to adjust for overhead assumption, whether there is under or over absorption. So in that case, you can't just come here and put under slash over. No, you need to go and do your working first. It is a working that will tell you what you are going to put there. So let's go and do working for overhead absorption. That will take us to working number 2. You see the way we are doing it? That is the exam approach that you must adopt. Working number 2 now. Overhead absorption. Or let's just call it under slash over absorption. Don't know why my pen is not flowing well. Now, let's refresh our memories on what we did, on what we discussed last time in relation to overhead absorption. Yes, Alani, you talk to me.
Good evening, sir.
Yeah, good evening.
Sorry, sir, I'm confused how you get that 8 naira that you use under the marginal cost push.
The total cost per unit is 12 naira. So we are looking for total variable cost per unit, right? Direct material is 5 naira. Direct labor is 2 naira. Variable production overhead is 1 naira. When you add it up, that's 8 naira. If you don't want to follow that route, you know total cost per unit is 12 naira. You less fixed cost per unit, that is your fixed overhead absorption rate of 4 naira. So that will give you 4 minus 12 naira will give you 8 naira. Is it clear, Nii?
Very clear, sir. Thank you, sir.
All right, then. So now, like I explained to you last time, and also reminded you earlier today when I was doing the recap, I said that the overhead absorption costing is the process of charging or of allocating indirect cost to a product or service. Ordinarily, the budgeted overhead is supposed to be equal to the overhead absorbed to products. But in most cases, what the overhead absorbed to products may be different from what was, initially planned to be incurred as fixed overhead. So when this happens, it will result to under or over absorption. And we said that when this happens, you need to make adjustment from your cost of goods sold. We said under absorption will arise when the budgeted overhead is higher than the overhead absorbed to products, because this will understate the cost of goods sold and over-reported, and over-report the profits. Okay, the cost of goods sold will be lower when there is under absorption. The cost of goods sold will be lower, and then the profit will be higher. So to correct this, when you have under absorption, you are supposed to add to cost of goods sold. The reverse is the case under the over-absorption. For over-absorption, we said it occurs when the budgeted overhead is lower than the overhead absorbed to product. That is the overhead the company charge to product. All right. When this happens, the cost of goods sold will be overstated. When the cost of goods sold is overstated, the profit will be understated, or the profit will be underreported. So when this happens, the difference will be deducted from the cost of goods sold. So this is the treatment we discussed in our last class. Now we want to put it into practice. Let's see how it will work out. Okay, first thing first, I have two approaches that I can use. If I like, I can do, I want to teach you the exam method, which is faster. So for you to be able to do this, first thing first, you need to determine the budgeted overhead. So I will come here, budgeted overhead. And I said that budgeted overhead is the budgeted units. This is budgeted units or budgeted output multiplied by the fixed overhead absorption rate. So in this case, examiner told us in this question that the company will produce and sell 10,000 units. So that 10,000 units is the budgeted output. Then multiply by the fixed overhead absorption rate of 4 naira. Okay, the fixed cost per unit is 4 naira. Therefore, you then multiply. This will produce 40,000 units. Sorry, 40,000 naira. So what we budgeted to spend as overhead, as fixed production overhead, is 40,000 naira. Now let us determine the actual overhead absorbed to product. What is the cost? What is the overhead, the fixed production overhead absorbed to product in period 1, period 2, and then period 3? Okay. So we then need to compare. We compare this budgeted overhead of 40,000 naira. Okay, this 40,000 naira. So we compare it with the overhead in the first period. So I can then say overhead absorbed. So when you say absorbed, what we simply means is that overhead charged to product, or the overhead allocated to products. All right. So we are going to pick it period by period. So starting from period 1. So in period 1, how many units were produced?
10,000 units.
Period 1.
10,000.
10,000 units. Here will be 10,000 units. That's the actual unit produced, multiplied by the fixed overhead assumption rate of 4 naira. So this will give us 40,000 naira. So which means that in period 1, the overhead is appropriately absorbed. So in this first period, you can say, this is for explanation purpose. Don't go and be, it's a waste of time to be doing this on the day of your exam. So you can say the overhead is correctly or appropriately absorbed because the budgeted overhead and overhead absorbed to product are equal. 40,000 equal to 40,000. No issue in period 1. So that means in that period 1, just put a dash. There's nothing like under or over. Okay. Then let's move to period 2. In period 2, how many units were produced?
8,000.
8,000 units were produced in period 2. Multiplied by fixed overhead absorption rate of 4 naira. So this will give us 32,000 naira. Okay. Here is 32,000 naira. What's wrong with you? So this means that in this period 2, we need to compare what we budgeted to incur of 40,000 naira. You compare with the overhead charged to products. So in period 2, we were supposed to charge 40,000, but we allocated 32,000 to to the product. That means we have under absorbed the overhead. So in this period too, it is under absorbed. This is under. This is under. Let me put it this way. The overheads. Let me do this better. The overhead is under absorbed. What's wrong with this thing? Is under absorbed. So when this happens, what are you supposed to do? You add. This is under absorbed. You add it back to the cost of goods sold. So you are supposed to allocate, you are supposed to charge 40,000 to the product. You end up charging 32,000. That means it is under absorbed. So what do? In this case, you add to cost of goods sold. That's the treatment. That's what we are going to do. Then in period 3, how many units were produced?
11,000.
11,000 units were produced. Multiplied by 4 naira fixed overhead absorption rate. This will give us 44,000 naira. So you then compare this 44,000 naira to the budgeted overhead of 40,000. You are supposed to charge 40,000 naira to the product in period 3, but the actual overhead absorbed is 44,000. That means you over absorbed, isn't it? So when this happens, what are you supposed to do? You deduct this from the cost of
Absorb.
goods sold. Let me just put it down. The overhead is over absorbed. Okay, the overhead is over absorbed. Therefore, what are you supposed to do? Deduct. You deduct the difference from cost of goods sold. That's the treatment. Okay, so that's that. So you are not deducting the entire 44,000 or 32,000. It's the difference between the budgeted and also the overhead absorbed. So in the first period, we don't have any issue because the overhead is appropriately absorbed. So in this case, in the first period, we put dash. So let's go back to our main presentation. So I can say under, because in our workings, we have under, we also have over. Okay, because of space. This is working number, let me just do it this way. This is working number 2. All right. So in the first period, we have dash, nothing. Therefore, 96 plus nothing will give us 96. 96 minus the 6 of 128. What do we have? 128 minus 96.
32.
That's 32,000. So here is 32,000. So here is 32. This 32 is called gross profit. After gross profits, we are supposed to deduct non-production cost. We are supposed to deduct non-production cost. According to the question, we don't have anything like non-production cost. So since we don't have non-production cost, just ignore that line item, okay? So you can just come here. Remember what I told you. When you say non-production cost, the non-production cost could be variable or fixed. For example, you can have variable selling and distribution expenses. You can have variable admin expenses. You can have variable fixed selling and distribution. You can also have variable admin expenses. Any expenses, any cost that is not related to production that you are given in the question will come under the non-production cost. Let me just put it there, not production. Let me shorten it because of space. Non-production cost. So in this question, we don't have any. Just put a dash. All right. Then that will give us our profit will then be equal to 32. In the question, we don't have anything like tax. We are not given company tax rate. So which means that our profit before tax will be the same thing as the net profit since we don't have a tax. So in the first period, we are done with our presentation. Let's go to the second period. All right. So in the second period, what is the sales? What are the number of units sold?
9,000.
In the second period, we sold 9,000 units, then multiply by the selling price of 16 naira. What do you have?
144,000.
144. Okay. Then opening stock. The closing stock in the first period, the closing stock in the first period will become opening stock in the second period. Therefore, here will be equal to 24,000. Then, in the second period, how many units did you say we produce? 8,000 units, right?
Yes.
So 8,000 multiplied by 5 naira. You know, direct material cost per unit is 5 naira. So 5 naira multiplied by 8,000. So that will give us 40,000. Then direct labor is 2 naira. Multiplied by 8,000 units will give us 16,000. Variable overhead per unit is 1 naira. Multiplied by 8,000 units will give us 8,000. Then the fixed overhead, we've already calculated this, all right, which is 32,000 because the fixed overhead assumption rate is 4 naira multiplied by the unit produced in the second period, which is we produced 8,000 units multiplied by 4 naira will give us 32,000. Okay, so add everything together. 40, 96, 120,000. Okay, then closing stock in the second period for ACA, we have calculated it. In the second period, our closing stock is 12,000 naira. Yes, Kaude, what's your question?
Sorry, sir. Can you come again on how we got that 144?
Which 144?
That's the sales for period 2. I skipped there.
For your sales. Okay.
Exactly, yes,
sales is selling price. Selling price multiplied by units sold. Is it clear now?
Thank you, sir.
All right then. Okay, now that we have in the second period, our closing stock is 12 naira. Therefore, 120,000 minus 12 naira. What do you get?
108.
108. That's cost of goods sold in the second period. From this, you then consider under or over absorption. In the second period, we have calculated our overhead absorption, and in the second period, it was under by 32,000 naira. So here is 32,000. So because it is under, we are supposed to add to cost of goods sold. In case somebody is asking me, let me repeat what I've just said. This is where we are coming from, the overhead absorption that we have done here. in the second period, we have calculated 32,000. So in the third period, we calculated 44. So let's just put the 2 so that we don't need to come back here. In the second period, it was over. It was over. So you have to put it in brackets. So 32 and then 44. All right. So here is 32. This guy here will be 44. Let me see. Yeah. This guy will be 44. Sorry, not the full number. 32 minus 40,000. Let me,
That's the question I wanted to ask now.
So that I don't confuse you, let me go back there. Remember I told you it's the difference that you are going to
Yes.
consider.
That's
So let me just
8,000.
come here. So let me just put it under equal to the budgeted. Okay.
40,000.
Budgeted overhead minus overhead absorbed, which is equal to 40,000. Is that the first period? Okay. 40,000 minus 40,000 equal to 0. So in the second period, I said it is under because 40,000, which is budgeted, minus the overhead absorbed of 32,000. The difference of 4,000 should be added to cost of goods sold. Then under the period 3, we said this is over. This is over. Why? Because the budgeted overhead of 40,000 naira is less than the overhead you charge to product of 44,000. The difference of 4,000, the difference of 4,000 naira should be deducted. Okay, this should be deducted. What's wrong with you? Deduct from cost of goods sold. So that's my explanation. Yes, Chidera, talk to me.
This period too. Are you with me, sir?
Yeah.
Period is supposed to be 6,000.
Period 2 is supposed to be 8,000, not 4,000. Because if we minus 40 to 30 from
8,000,
32,000, it will give us 8,000.
Yeah. Thank you, Jerry. Thank you. It's 8,000. Error of mind. I want to know whether you are following me. Am I correct? On a lie. That's a lamba. Okay. All right. Thank you. So 8,000 in the second period. This guy is 8,000, and the 8,000 should be added to the cost of goods sold, which will give us 116,000. 116,000 minus 6 of
28,000.
144. What do you get?
28,000.
116, 28,000. So here is 28,000. We don't have anything as non-production cost. Here will be 28. Lastly, in the third period, the sales value in the third period we sold 12,000 units, right? Then multiply by 16 naira. What do you get?
192.
192,000. The closing stock in the second period of 12,000 naira will become opening stock in the first on 1st January of the third period, which is here will be 12,000 naira. Okay, then direct material is 5 naira multiplied by the unit produced in the third period. What do you have there?
5.
Pardon?
55,000.
55,000. Okay, that's 11,000 units multiplied by 5 naira. That's 55. Then direct labor is 2 naira multiplied by 11,000 units. We give us 22,000. Variable overhead is 1 naira multiplied by 11,000 units. 11,000. Then the fixed overhead per unit is 4 naira multiplied by 11,000 units will give us 44,000. Add it up. 55 plus
144.
55. 144. Here is 144. The closing stock in the third period is 0. We don't have any closing stock. All right. So here will be 144 minus 192. What do we have?
48.
48,000. So in the third period, the cost of goods sold is 48,000. So, and then in the third period, we have over absorption of 4,000 naira. Because it is over, we are supposed to deduct. Therefore, 48 minus 4,000 naira will give us 44. Okay, so that's that. And then since we do not have non-production costs, the 44,000 will then represent the profit before tax or net profits. Here will be 44. So we are done. This is how to present income statements using the absorption costing method. Okay. Now, this is what I was trying to say the other time, which we have already calculated. This is your overhead absorbed to product. This is the overhead you charge to products. Your fixed overhead, that's the overhead you charge to products. You are supposed to charge 40,000 naira in the first period, and you end up charging 40,000. That was why we don't have any issue as per under or over absorption in the first period. In the second period, you are supposed to charge 40,000 naira as fixed production overhead. You end up charging 32,000, and we said that is under absorption. So because this cost of goods sold of 108,000 naira is underreported, that is on the 108,000 naira is understated, because this 32,000 supposed to be 40,000. That means the cost of goods sold of 108,000 is undercharged, is underreported, or is understated. So when this happens, the difference between the budgeted overhead and the actual overhead absorbed supposed to be added to the cost of goods sold. That's what we did in the second period. Then in the third period, the company is supposed to charge 40,000 naira overhead, fixed overhead, but the company end up charging 44,000. That means you have overcharged. So in this case, your cost of goods sold of 144,000 is overstated. If your cost of goods sold is overstated, it means that your profit will be also be overstated. Sorry, your profit will be understated. So to correct this, what are you supposed to do? You deduct the difference, and that's why we deducted this out of this 48,000, which is a cost of goods sold. You deduct the 4,000 naira from there to ensure that the profit is appropriately reflect the actual result. So that is what we have done here. All right. So the next one we want to do,
Sorry, sir.
yes,
For the cost of goods sold for the third period, I believe it
yeah,
should be 144.
one what?
144 before we now remove the over assumption.
Oh, okay. So yes. So okay,
Yes,
sorry.
I
What you are
observed that
saying,
too.
of course, this one's supposed to be 144. Yeah. Thank you. 144. 144 minus 8. Sorry, minus 4. Yeah, you're correct. Thank you for that observation.
That will not affect the gross profit.
This one will now be 140, right?
Yes,
This should be 140. So 140 minus 150, 192. That will be
52.
52,000. Yeah,
Yes.
correct. Thank you. I was doing something else. That means my mind was not there in actual sense. Okay then. So thank you once again. Now let's move on. The second one is to prepare using the marginal costing approach. All right. Operating statements using marginal costing approach. Our figures are in thousands. Okay. Let me complete my table first. So we have period 1, period 2, then period 3. Let's divide each period. All right. Go. So divide each period into 2. So this one should be faster than the first one because this one does not have under absorption, overhead absorption. Okay. So the first item here will be sales. The sales value in the first period let's repeat the sales value under absorption: 128, 144, 192. 128, 144, 192. Then production cost. Opening stock. Dash. Direct material. Give me the direct material under the first period.
50.
50. Direct labor.
20.
Okay. Variable overhead.
10.
10. Okay. So remember, when you are using marginal costing approach, fixed production overhead is not part of production cost. So we are not going to include fixed production overhead as part of our production cost. So here will be equal to 80,000. This represents cost of goods available for sales. After this, we deduct closing stock. Based on our workings, the first working that we did, closing stock for MCA, marginal costing approach, in the first period is 16,000 naira. So here is 16,000 minus 80,000 will give us 64,000. This represents cost of goods sold. Immediately after the cost of goods sold, you are supposed to add variable non-production costs. Okay? Variable, add variable non-production cost. Okay, I
Alright.
shorten it, variable non-production cost. So in the question, we don't have, do you have any selling expenses?
No.
Selling expenses. We are not given any selling expenses, so you are going to ignore. All right, since we don't have selling expenses, you ignore that information. Okay. So just put a dash. Then in that case, here will be 64. 64 minus 128 will give us 64,000. This represents contribution. Remember we said marginal costing approach uses contribution, unlike absorption costing that uses gross profit. So that's what I mean by that. Then after contribution, the next thing you are going to do is to less the period cost. The period costs are those costs that are fixed in nature. Under this, in the question, the only period cost we have is the fixed production overhead, the fixed overhead. So I will come here fixed overhead. So since we only have one line item, so there is no need for us to be stressing ourselves. So, and we have calculated the fixed overhead in the first period to be 40,000. Remember, I told you, under marginal costing approach, your fixed production overhead and other fixed costs are costs that has no sympathy for activity level, meaning that irrespective of production volume, irrespective of the actual unit produced, your fixed production overhead will remain the same. It will not change. All right, your fixed production overhead will not change. It is constant, and we have calculated budgeted overhead to be 40,000 naira. Therefore, here will be 40,000. Which working did we do that one for? Let me, so that I can indicate it. Budgeted overhead. This is the budgeted overhead there, 40,000 naira. That's working number 2. So that when you are reading, you'll be able to see where the number is coming from. That's your budgeted overhead, 40,000. Minus 64,000 will give us 24,000. So that means the profits, since we don't have any other cost, so this is profit before tax, or you call it net profit. Okay, then move to the second period. In the second period, closing stock in the first period of 16,000 naira will become opening stock. Then, in the second period, what's the material cost? Material cost is 40,000. I have 40,000, 16,000, 8,000. So here will be 40, 16, then 8. Add it up. What do you get? 24. That's 80,000. Okay. Then closing stock. In the second period, under the marginal costing approach, closing stock in the second period is 8,000 naira. 8,000 naira. So here is 8,000 minus 80,000 will give us 72,000. Okay. Then you had variable non-production cost. Since we don't have any variable non-production cost, so here will be 72,000. 72,000 minus 144,000. That will give us 72,000. So that represents the contribution for the second period. It then less the period cost. Remember what I told you. Under marginal costing approach, fixed production overhead and other fixed costs are costs that have no sympathy for activity level. They will not change. They will remain constant. Why? Because it is based on the budgeted output. And we have calculated budgeted output to be 40,000 naira. Okay, so this one too will be 40,000 when we get there. So you can see it is constant, but under the absorption costing, you see that your fixed production overhead is changing. In the first period, it was 40,000. In the second period, 32,000. In the third period, it was 44,000 because it was based on the actual unit produced. That's why it is changing. It's part of production cost. But under the marginal costing approach, it will remain constant because it is based on the budgeted output. Budgeted output is 10,000 units. Fixed overhead absorption rate is 4 naira. 4 naira multiplied by 10,000 units will give us 40,000 naira. That's why you see everything is 40,000 naira constant. Okay, so 70,000 minus 40 will give us 32,000. That's the profit in the second period. Finally, we'll move to the third period. So closing stock in the second period is 8,000. This will become opening stock at the beginning of the third period. Again, direct material, direct labor, and variable overhead in the third period, 55, 22, 11,000. 55, 22,000, then 11,000. Add everything together, what do you get? This is 33, 88, 96, I think, yeah.
Yeah, 96.
So closing stock in the third period, we don't have closing stock. So you put a dash. Here will be 96. Then you had variable non-production cost. We don't have any. So here will be 96. 96 minus 192 will give us 96. Okay, that will be 96. 96 minus 40,000 will give us 56,000. So on the day of your exam, don't go and be doing this kind of presentation. All right. If as you are ruling your table, you must ensure that you complete your table. Don't say because you are so much in a hurry, you rule one part, you ignore the other part. You know, when I was doing I did not know the extent of my figures. I just rule it and I stop here. So you are supposed to complete it. You are supposed to complete it in your own notes, so that you don't go and be doing have a presentation. They will say, oh, okay, that's the way Mr. Adejuwon did it in the class. That's not me. Oh. That's not what I taught you. You have to do the right thing because you have to tabulate where necessary. Now that you have computed the operating statement using marginal and absorption, then let's prepare the reconciliation statement. In the B part of the question, examiner is asking you, excuse me, you are to comment on the difference of the two profits as regards stock valuation and period profits. What the examiner is simply asking you that you see that the profits in the first, the profits of the two techniques, under the two techniques are not equal. So examiner is simply asking you to explain reconciliation statement or variance analysis. So you just say that the profits under the absorption costing method and profits under the Okay, let me just put it down for you. Number B. Number B. You then say the profits under the absorption costing and marginal costing method or costing approach are not equal due to, when you look at the profit, this is what we are saying. You know, using the absorption costing method, profit in the first period was 32,000. Meanwhile, under the marginal costing, profit in the first period is 24,000. In the second period, under absorption, profit is 28,000. Whereas under marginal, profit is 32,000. In the third period, under absorption, 52,000. Then under marginal, it is 56,000. So why are they not equal? That's examiner says you comment on the profit and the stock valuation. So that's what we are currently doing. So you then say the profit under the absorption costing and marginal costing approach are not equal due to the different method of valuing stock. Full stop. Absorption costing because of time. So you have to finish. We have to finish the second question on this almost 10. So I will just say ACA values stock using total costs, using total costs per unit, using total costs per unit, whereas the marginal costing approach value stock using total variable costs, using total variable costs per unit. The difference in profits under the two techniques can be reconciled using the reconciliation what is this? Reconciliation statement as shown below. Okay, so that's what the examiner is asking you to do. So let's prepare the reconciliation statement now. So I will then say reconciliation statement. reconciliation. See, it's only one question we are solving since, so that's what I said, because we have multiple period. It will take time. All right, so here will be period 1, period 2, then period 3. I'm very sure most of you will be waiting for me now to see whether this one will balance. Maybe Mr. Rejuan said, once you prepare your reconciliation statement and it balance, then it means that what you have done is correct. I'm very sure some of you will be waiting for me to see whether it will balance or not. No worry. Once you do the right thing, certainly it will balance. Remember, when you are preparing your reconciliation statement, you need profits, you need difference in profit before tax. You don't need profit, you don't need difference in net profit. It has to be profit before tax. So I will then go to the question. Under the ACA and then MCA, what is the profit before tax in period 1? In period 1, let me do it this way so that we have two different don't know the extent of my table. Let me just do anyhow. This one to 2. This one to 2. And this one to 2. Okay. Now, based on our calculation, in the first period, how much was your profit before tax? So yeah, give it to me. 20 what?
32,
Or is it
sir.
32?
32.
32. So here will be 32. Under MCA, first period, what do we have?
24.
20.
I can't see your voice.
24.
24.
24. What's the hiatus?
8.
8 is the difference. So this is difference in profit. This is A. Let's do for period 2, once and for all. Profit before tax, period 2, ACA. Give it to me.
28.
28.
28.
32.
32. The difference is what? 4. Negative. Negative 4. Then in period 3, ACA, profit before tax.
44.
52. 52.
52. MCA,
56.
56. And the hiatus is 4,000 negative. So that's that. We have found the difference in profit for each period. So we also need to determine difference in stock valuation. So I will then come here, difference in stock valuation. Under this, we are going to start with closing stock. For ACA and then MCA. So, under the ACA, in the first period, how much was our closing stock? Was it 24? Yeah, we
Yes,
have the working here
24.
close by.
24.
24, then 16. Here is 24 minus 16. So this will give us what? 8, right? This is 8. This is difference in closing stock. So we then do opening stock. We want to find difference in opening stock for ACA and then MCA. Opening stock in the first period. Opening stock in the first period. How much was opening stock for ACA dash? We don't have anything opening stock. Under MCA, what's the opening stock? Dash. We don't have any. Dash minus dash will give you dash, abi? Then 8 minus 0 will give you 8. So in the first period, we have difference in stock. Difference in stock. This is B. So difference in stock in the first period is 8,000. Let me complete my table. Like one of our old musicians will say, don't teach me nonsense. So that you don't go to the exam hall and be doing, when you are supposed to prepare your table, you do one side, you ignore the other side, or say that's the way we are taught. No, I will never allow you to hold me responsible for anything. Yeah, that's me for you. Okay, let's move to the second period. In the second period, we of course, we are finding the difference in profits. So closing stock in the second period, okay, which is 12 and then 8,000. 12 and 8,000. Here is 12. Here is 8.
Yeah.
The difference is 4,000. Let me write this, make it bigger. Okay, then opening stock in the second period. Opening stock will be closing stock in the first period, isn't it? Here will be under ACA, opening stock is 24,000. Here is 16,000. So the difference will be equal to 8. 4 minus 8 will give us minus 4. All right? Then move to the third period. In the third period, we've already found the difference in profits. So let's do difference in stock valuation for the third period. All right? Which is closing stock. In the third period, closing stock is 0. We don't have any closing stock. Okay, no closing stock. Therefore, this one will be dash. 0. That is 0. If you like, you can put 0 or put dash. All right, then opening stock. Opening stock will be the closing stock in the second period. All right, so here will be equal to 12. Here will be equal to 8. So 12 minus 8 will give us 4. 0 minus 4 will give us minus 4. That's it. A must be equal to B. A must be equal to B. All right. The difference in profits, the difference in profit of 8,000, 4,000, and then 4,000 in the first, second, and third period must be equal to difference in stock valuation of 8,000, 4,000, and then 4,000 for first, second, and third period. So that is the end of the question. Let me know if you have any question for me. If not, let's quickly have additional illustration, and that will be the end of today's class. Let me see. Okay, let me see somebody saying my chat. Okay, they were trying to correct the old one. Okay, then go ahead with your question. Talk to me.
Okay, good evening, sir. My
Talk to me.
question,
Yeah,
can you hear me?
I can hear you. Go ahead.
Okay. It's in regards to this fixed cost. When you are explaining it, you are a little bit fast, so I did not get it clearly. The fixed cost under ACA for period one, 40,000, period two, 32, period three, 44. But when it comes to the MCA, you use only the 40,000, which was in period one throughout. You did not use the 32 and then 44 in accordance with period two and period three. So I need more explanation on that.
You are not paying attention. That's why maybe you are distracted. I explained it to you. You know, last week my explanation was that even this earlier today I mentioned it. When I was solving, I also mentioned it. What we are saying is that when you want to determine fixed production overhead under the absorption costing method, your fixed production overhead will vary based on the activity level. That is, the more the company produces, the more fixed overhead that the company will incur, and vice versa. But under the marginal costing approach, fixed production overhead is not based on the actual production because it is based on only budgeted output. It is based on the units budgeted for. So that's why you see it is constant. And I also explained to you that when you look at our calculation, for example, under the absorption costing, that's when I draw this line, you will see that in period one, our fixed production overhead is 40,000. In period two, 32,000. In period three, 44,000, because it was based on the budgeted output. It was based on actual units produced. That's why you see that it's changing. In the first period, we produced 10,000 units. In the second period, we produced 8,000 units. In the third period, we produced 11,000 units. You multiply each of the units by 4,000 by 4 naira per unit. So that's how we got all those numbers. Ogun Fowora, you are marking on my screen. Stop it. So that's how you got all those numbers. But under marginal costing approach, fixed production overhead will remain constant. I told you that fixed production overhead and other fixed costs are costs that have no sympathy for activity level. That is, it will remain constant. It will not change because it is based on the budgeted output. Budgeted output is 40,000 naira. And then fixed budgeted output is 40,000 naira. Sorry, 10,000 units. You multiply with 4 naira fixed overhead absorption rate. That's how we got the 40,000. The 40,000 you are reporting, is it Ogunfowora or let me see. I think it's Ogunfowora. That should be Nii. So you are the one writing on my screen. You are the one writing on my screen. We are going to quarrel. So this is the 40,000 naira we calculated for the budgeted output. This is the 40,000 naira here. If I allow my pen to stop. So this is the 40,000 naira you are seeing here. So this 40,000 naira, that's your budgeted overhead. You can see it's constant. We have multiplied the 10,000 units with the 10,000 with 4 naira. That's how we got the 40,000 naira. So that's why you see under the marginal costing approach, the fixed production overhead remain constant at 40,000 naira. I believe that's clear now. Phillips.
Yes. Thank you, sir. Yes, sir, it's clear.
Edward, what's your question?
Okay, sir, my question is, if you look at period three, when we did the opening stock,
Pardon?
if we look at period three, when we did opening stock in the reconciliation, ACA is 12, MCA is 8. So we have positive
I don't know
for.
whether it's my network.
Hello?
I don't know. Hold on, Edward. Your line is, I don't know whether it's my line or your own line is breaking.
Oh, God.
Go ahead.
Sir, can you hear me now?
Edward, go ahead. I can hear you. Go ahead.
Okay, sir. Sir, in deciding if A is equal to B in the reconciliation, are we taking absolute values, ignoring the signs?
Take it again. Take it. I didn't hear the beginning of your statement. Take it again.
In the reconciliation statement, in deciding if
Yes.
A
Uh-huh.
is equal to B, are we ignoring the signs? Because if you look at period 3,
Uh-huh.
the difference in stock
Yes.
is a positive 4, while the difference in
Who
profit
told you it's a positive? Who told you it's a positive?
is it not 12 minus 8?
In period 3, it's not possible. 0 minus 4. What are you going to get? This one is 0 now. 0 minus 8. Sorry, 0 minus 4. We'll give you minus 4 now. This one is 0. Let me just hold on. Let me go in because my pen has stopped working. Let me just hold on for me. Let me just wait a few seconds. So, Edward, ask your question again.
Go ahead, sir. Go ahead, sir. It's clear now. I have seen it.
So,
I have seen it.
sorry.
Yes.
So in the absence of no further question on this, let's have one more illustration quickly. Let me stop sharing this and move to the question. Let's solve illustration number 2. I need one of you to read for us. Illustration number 2. Who is helping us to read quickly? I read the first one, so I need one of you to read this. Let me see. Who is helping us? Hey, this is the first time people will be refusing to read.
Sir?
Students are
Hello?
always happy to read now because you want to hear your voice. Yes, Sir K, please go ahead.
Canada's company limited manufactured fish towel. Standard unit cost of its productions are given below. Direct material 1.60 kobo, direct labor 1.50 kobo, variable manufacturing overheads 1.20, fixed manufacturing overhead 3 naira, total 7.30 kobo. At normal operating capacity, 200,000 units of product should be manufactured. Variable selling and administrative expenses amount to
I don't know whether it's my line is breaking.
Can you hear me, sir?
Yes, go ahead.
Can you hear me? Okay. At what point did it break? Should I start at normal operating capacity? Okay. At normal operating capacity, 200,000 units of product should be manufactured. Variable selling and administrative expenses amount to 50 kobo per unit, and fixed selling and administrative expenses amount to 75,000 a year. Income taxes at 40% of net income before taxes. Production and sales data for year 2008 and 2009 in units. Inventory on hand, January 2008, 28,000. Production for year 2008, 200,000. Sales for year 2008, 160,000. Production for year 2009, 150,000. Sales for year 2009, 180,000. In both years, each towel is sold for 10 naira 50 kobo. Required, prepare income statement for the years by absorption costing method, variable costing method, prepare reconciliation statements to show where there is difference between the results of the two methods.
Thank you very much. Okay, so that is the question. Examiner wants you to prepare income statements using ACM, VCM. Variable costing method is the same thing as marginal costing. All right. And then you should also prepare reconciliation statement. Within the next 30 minutes, let's quickly solve this question. Again, let me see. Solution to illustration 2. page 19, I think. Let me confirm.
You're right, sir.
That's page 19, correct. So the
Yes.
name of, thank you. The name of the company is Fernandes Limited. Fernandes Company Limited. So Fernandes Company Limited. What are we asked to do? We are to prepare income statements using absorption costing method. So we then come here. That should be 0 figure 1 or A. Okay. In the A part of the question, we then say income statement using absorption costing method. Please, I beg of you, on the day of your exam, don't go and be writing ACM. You have to write it out in full in the first instance. Absorption costing method in brackets ACM, so that going forward you'll be referencing ACM. Don't go and be writing ACM just the way I'm writing it like this. If you do this, examiner may penalize you because you don't want examiner to be racking his or her brain. What do you mean by ACM? Right? So, and that's why it is important in the first instance, if you know that you want to shorten your words, so in the first instance, you write it out in full, then in brackets, you write down the acronyms. So going forward, it is your acronyms you'll be referencing. Okay, so we have just two periods in this question, which is period ending 2008 and then period ending 2009. Okay, so in this case, we have 2008, then 2009. It's the same approach. That's what I told you last week. Once you master the format, you can't do no wrong. You can't go any wrong. You are going to get it correctly. Just know what you are doing. Your starting point is the mastering of the formats. In fact, once you master the formats, the urge will be there to want to test it. You want to practice questions. So you master the formats, you memorize it, you master it, then you close your book, right? Close your book, then do it on your own. So our figures, we restrict our figures to thousands. This will save time. So the first item will be sales value. You then go back to the question. According to the question, in 2008, the units sold was 160,000. 160,000 units was sold, and selling price per unit is 10 naira 50 kobo. Therefore, 160,000 160 multiplied by 10.5. We have 16,000, we have 1680. Here is 1,680. Our figures are in thousand. Then we determine production cost. Under this, the first item will be opening stock. So we go back to the question to go and identify if we are given any opening stock. Yes. In the table, in the second table in the question, we are told that inventory on hand, 1st January 2008, inventory was 28,000. So 28,000, because we are using absorption costing, this will be 28,000 units multiplied by the total cost per unit. How much is total cost? Total cost per unit is 7.30 kobo, according to the question. So let me shorten this so that I can just write it by the side. Opening stock. Okay, let me just go and do the working. Opening stock, working number 1. Because you say that's the way Mr. Dejuwon did it. This is 2, this is 3, then this is 4. So working, we have to be fast in this one so that we can finish on time. Opening stock equal to 28,000. Opening stock in 2008. 2008 equal to 28,000 units multiplied by, okay, let's do it this way. in 2008, using ACM, absorption costing method, it will be equal to 28,000 units multiplied by total cost per unit, 7 naira 30 kobo. So what do we have here? 28 multiplied by 7.3. What do we get?
204.4.
204.4. Then opening stock under the marginal costing, sorry, examiner use variable. You have to use what examiners use. Variable costing method, which is 28,000 units multiplied by, then go to the question, how much is total variable cost per unit? 1 naira 60 kobo plus 1 naira 5 kobo, 1 naira 50 kobo plus 1 naira 20 kobo. That will give us 4 naira 30 kobo. Or you can say total cost of 7 naira 30 kobo minus 3 naira fixed overhead. So that will give you 4 naira 30 kobo. All right. Okay, then. So 4.3. So what do we have here?
120.4.
120.4. Okay. So that's that. Let's go back there. Here is 204.4. Then we have direct material.
Sir, please do not get that workings number one very well, sir.
You did not do what?
I did not get the working number one very well.
I will show you later. Direct material is 1 naira 60 kobo plus, multiplied by the unit produced in 2008. The company produced 200,000 units. Therefore, 1.6 multiplied by 200.
320.
That's 320. So here will be 320. Yeah. Is that Phillips who is asking this question that you don't understand how we got the 204.4?
I'm the one, sir.
Okay. That's Olalekan, right?
Yes, sir.
So this is, we have done the working. Maybe you are not paying attention when we did it. This is how we got the 204. Just multiply the opening stock in units by the total cost per unit. Then for variable costing method, opening stock in units multiplied by variable cost per unit. Total variable cost per unit, we got 120,400 naira. Is it clear now, Likon? Likon?
Yes, sir. It's clear, sir.
All right. So, okay then. After direct material, we also have direct labor. Direct labor per unit is 1 naira 50 kobo. So direct labor, 1 naira 50 kobo multiplied by 200,000 units produced. This will give us 300,000. Okay. Then, do we have direct expenses? We don't have direct expenses, but we have variable manufacturing overhead. So I will then say variable manufacturing overhead. The variable manufacturing overhead is 1 naira 20 kobo multiplied by the unit produced of 200,000. So that would be 240,000. Next, remember, we are using absorption costing method. Therefore, you must include fixed manufacturing overhead. The fixed manufacturing overhead per unit is 3 naira. So 3 naira multiplied by 200,000 units produced. That will give us 600,000. So add everything together. What you get? Let's be faster.
164.4. 166.4.
166.4. 4.4. Okay. So we then less closing stock. Working number 2. Let's go and do workings for our closing stock. Working number 2. Closing stock. 2008. Then 2009. To get the closing stock, you pick the opening stock. You had actual production or output, actual unit produced. You have the total units available. Then you less units sold. Then you are going to have closing stock in units. It is well. You know, after a very busy day. In 2008, opening stock is 28,000. Then we produce additional 200,000. Then we are going to have 228,000. In 2008, we sold 160,000 units. So closing stock will be 68,000. The closing stock in 2008 will become opening stock at the beginning of 2009. So here will be 68,000. How many units were produced in 2009?
150.
150,000 plus 68,000, 218,000. How many units were sold in 2009?
180,000.
180,000. So the difference of 38,000 is unsold stock. So we then need to value this. Valuation. In 2008, under absorption costing method and variable costing method, in 2008, we had 68,000 units. Using ACM, it will be our total cost per unit. Total cost per unit is 730 kobo. Give it to me. What do you have there? Yes.
496,
496.4. Okay. Then using margin variable costing method, the total variable cost per unit is 4 naira 30 kobo. Multiply by 68,000. What you get?
292.4.
292.
4.
0.4. So let's do for 2009, once and for all. ACM, variable costing method. In 2009, 38,000 units were unsold. Multiply by 7 naira 30 kobo. Give it to me. What do you have?
277.4.
2.4.
277.4.
277.4. Then 38,000 units multiply by 4 naira 30 kobo. Give it to me.
163.4.
163.
3.4.
163,400.
0.4. Thank you. So that's that. So let's go and post. Under the ACM, closing stock is 496.4. 496.4. Here is 496.4 minus 1664.4. What do you get?
One one six
Okay.
eight.
1168. That's closing stock. Immediately after closing stock, you need to consider overhead absorption. We then go ahead and do calculation to see what we are going to put there. Working number 2 now. Overhead absorption. Working number 3 rather. Overhead absorption. First thing first, you must calculate the budgeted output. Or let me use another approach. Let me use another approach here. Okay. So we have 2008, then 2009. So you are going to compare the budgeted output with the actual output. According to the question, what's the budgeted output? We are told that at normal operating capacity, 200,000 units of products should be manufactured. So budgeted output is 200,000 units. So here will be 200,000. Here also will be 200,000. In 2008, how many units were produced? 200,000 were produced in 2008. Okay. In 2009, we produced 150,000 units. Therefore, this will be in 2008. This is units variance. So here is dash. Here is 50,000 positive. Once the difference between budgeted output and then actual output is positive, you should know that it is under. Anyways, so to now get the overhead, absorbed, to get the variance, let me put it this way. That's not good. Overhead will be equal to unit variance multiplied by fixed overhead absorption rate. So in 2008, the overhead were properly absorbed. But in 2009, there is a variance. So in 2009, so we have under. because the budgeted output is greater than the actual output. So when that happens, it will be under absorbed. The overhead will be under absorbed. So the unit variance is 50,000 multiplied by the fixed overhead absorption rate. The fixed overhead assumption rate is 4 naira 30 kobo. So give it to me. What do you have here?
215,000.
215,000. Sorry, is it 4.3 or 4 naira? Sorry. Fixed overhead absorption rate is 3 naira now, isn't it?
3 naira. Yes,
So
3 naira.
it should be 3 naira, not 4. Variable cost is 4.3. So here will be 150,000 naira. 150,000. Okay. So in 2009, we have under absorbed. So we are going to add this to cost of goods sold. Add to cost of goods sold. That's it. So let's go up there. So this one is dash. We don't have anything. In 2008, the overhead was appropriately absorbed. So then less. This one will be 1168 minus the sales. What do we have? $1,680 minus
512.
512. So this represents gross profit. After the gross profit, what do? You consider non-production cost because we are using absorption costing method. Non-production cost. In the question, we have some non-production costs. Let's go back to the question. You are told in the question that variable selling and admin expenses amount to 50 kobo per unit, and fixed selling and admin expenses amount to 75,000 naira a year. So those are non-production costs. Okay, so I can say variable selling and admin. We also have fixed selling and admin to be 75,000. The variable selling and admin, according to the question, we are told that is 50 kobo per unit. So let's go and do working for that, because I know some people will ask me, how do you arrive at variable selling expenses? Let me just write it down for you. Working number 4, variable selling and admin. In 2008, we are told it is calculated as 50 kobo per unit. In 2008, how many units were sold? 160,000 units were sold. This is units sold multiplied by 50 kobo. 50 kobo is the same thing as 0.5. All right. So this will give us 80,000 naira. Our figures are in thousands. Please don't go and make mistake. This is our figures are in thousands. Okay. Then in 2009, let's do once and for all. In 2009, how many units were sold?
180,000.
180,000 units were sold. Multiply by 50 kobo. So that will give us
90,000.
90,000. So variable selling and admin expenses in 2008 was 80,000. Let's go and put it down. Here is 80,000. So 80,000 plus 75,000 will give us 155. 155 minus 512. What do you get?
57.
357. 357,000. Okay. So this 357,000 is called profit before tax. In the question, we are given tax rate to be 40%. So I would then say income tax, which is profit before tax of 357 multiplied by a tax rate of 40%. Give it to me. What do you have?
142.8.
0.8.
142.8. If you like, you can round it. That's 143, Abi. Or you do 142.8. 142.8. If you like, you can round it to 143. So what do we have here? What's the difference?
214.2.
Yes. 214.2. That represents the net profit. Here is net profit. Okay. We then move to the second period. Sales of the second period. In the second period, we sold 180,000 multiplied by 10 naira, 50 kobo. 1890. Okay. Then opening stock, we have calculated it before. Of course, opening stock will then be in 2009. Opening stock will be the closing stock of 2008, which is 496.4. Then direct material per unit, according to the question, direct material per unit is 1.6, 1 naira 60 kobo. Therefore, 1 naira 60 kobo multiplied by the unit produced. What do we have?
240. 240.
2 what?
40.
240. How many units were produced?
150.
In the first,
In the second period.
in 2000 and, sorry, in second period, that's 150,000. So multiply by 1 naira 60 kobo. So that give us what?
240.
240.
Okay, 240. Then direct labor.
225.
What do you have as direct labor?
225.
225. Okay. Variable overhead.
180.
180. Then fixed manufacturing overhead. 3 naira multiplied by 150. That's 450, right? Here will be 450. Add it up.
One 1591.4.
159.1.4. Okay. Then closing stock. We have done the working before. In 2009, closing stock is 277.4. Yeah. Let me write it. 277.4. Okay. So minus 1591.4. What do you get?
1314.
1314. Then we consider in 2009 we have under absorption. And we calculated what?
150.
50,000, 150,000 under absorption. Where is that? Yeah, we calculated 150,000. So since it is under, we had to cost of goods sold. Okay, so here is 150,000 plus 1314. That's 1464. 1890 minus 1464.
426.
426.
426. Okay, that's gross profit. Variable 426. So variable selling and admin in the second period, variable selling and admin,
90.
we calculated 90,000 naira. That's the 90,000 here. That is 180,000 units multiplied by 50 kobo. That's 90,000. So here will be 90,000. Then fixed selling and admin remains 75,000. When you add it up, that will give you 165,000. So 165 minus 426, what do you get?
261.
261,000. Multiplied by a tax rate of 40%.
104.4.
Multiplied by 40%.
104.4.
104.4. So what's the difference?
156.6.
One what?
56.
156.6. Okay. So that's that. This is absorption costing. You can spare me extra few minutes so that we complete this. When next we meet, we are moving to relevant costs for decision making. Let's quickly do marginal or variable costing rather. Number B, variable income statement. Variable costing method, figures in thousands. Okay. 2008, 2009. Right. Okay, so says here is 16. Is it 16? What do we have as our sales again? 1680, yeah. 1680, then 1890. Production costs. Under this, we have opening stock. Remember, We are using marginal here. Opening stock. We have done working for that. Opening stock 120.4. Here is 120.4. Then we have direct material. We have calculated direct material to be 320. Direct labor 300. 320. 300. Direct labor. We also have variable manufacturing overhead to be equal to 240. Here will be 240. Remember, we are using marginal, so you don't need to include, you are not going to include fixed manufacturing overhead. So give it to me. What do you have here as your COGAS?
980.4.
980.4. Then you less closing stock. Working number 2. We have done workings for closing stock, and we got 292.4. 292.4. So what's the difference?
688.
688. This represents cost of goods sold. We are using marginal costing technique. So you need to add variable non-production cost. So add variable non-production cost. In the question, we have variable selling and admin. We have variable selling and admin expenses, and we calculated 80,000 in the 2008, 80,000. So here will be 80,000. That's only variable non-production cost. So you had. So this will give us 768. 768 minus 1680. What do you get?
912.
912. That represents contribution. You then less the period cost. Under the period cost, you are going to have fixed manufacturing overhead. So we have calculated, have we calculated fixed manufacturing overhead before? Okay. Our fixed manufacturing overhead, that will be our budgeted output. So come here, number 5. Budgeted fixed overhead is equal to budgeted units multiplied by fixed overhead absorption rate is 3 naira multiplied by fixed overhead absorption rate. So budgeted output is 200,000 units. We have budgeted for 200,000 units. Fixed overhead assumption rate is 3 naira. Therefore, budgeted fixed overhead is 600,000. So this 600,000 will be constant for the period under consideration. So here will be 600,000. This is working number 5, I think. Was it 5 or 4? Then we also have fixed selling and admin expenses. We are told is 75,000. So add the two together. This will give us 675,000. 675 minus 912.
237.
What's the difference? 237. Thank
237.
you. So this represents the profits before tax. Then you charge income tax of 40%. Income tax,
94.8.
okay, 94.8. Here is 94.8 minus 237.
142.2.
142.2. That represents the net profit. Then move to the second period, 2009. The closing stock in 2008 was 292.4. So here it become opening stock, 292.4. Then what do you have as direct material? The same thing we calculated, 240, 225. 240, 225, 180. Add it up. What do you get?
937.4.
9,
37.4.
937.4. Okay, let me see. What did I put there? Yeah, it's 180, 225. 937.4. Okay. 937.4. All right. Then closing stock we have calculated before.
163.4.
63.4.
163.4. 163.4. So what's the difference?
774.
774. That's the cost of goods sold. You then had variable non-production costs. For the variable non-production costs, in 2009, I think we calculated 90,000 naira.
Yes.
Variable selling expenses, we
90.
calculated 90, yes, 90,000. That's it. So here will be 90. 90 plus 774, that's 864.
64.
Minus 1890.
1026.
1026.
1026. Okay. Then fixed manufacturing overhead is 600,000. Like I told you, under marginal costing approach, your fixed manufacturing or fixed production overhead will remain the same because it is based on the budgeted output. The fixed selling and admin also will remain constant. So here will be 675 minus 1026. What do you get?
351.
351 multiplied by 40%.
140.4.
140.4 minus 351.
210.6.
210.6. When you look at the net profit under the two techniques, you see that they are different. It's not the same net profits. It's not the same net profits you have. Therefore, you need to find the reconciliation. What is causing the difference is because of a stock valuation. Finally, number C, stock reconciliation statement. Reconciliation. Figures in thousands. So we do for 2008 and then 2009. All right. We're almost there. The next few minutes, 2 to 3 minutes will be done. Okay, so difference. So like I said, it has to be difference in profit before tax. Don't use difference in net profits. It has to be profit before tax. So you take the ACM, then VCM. So under the ACM, under absorption, what's our profit before tax? 2008.
357.
2357, then 261. 357. Here is 357, then 261. Is it 26 or 251? Let me check. 261. Then under the under the variable costing method, profit before tax, 237351.
Yes.
237251. Okay.
351.
Oh, sorry, 351. Error of mind. So give me the difference. Here will be 120.
120.
Then here will be 90, right? Minus 90. So
Yes.
this is
90.
difference.
Minus 90.
Okay. Difference in profit. A. Then we need to find difference in stock valuation. Difference in stock valuation. Under this, we are starting with the closing stock. For ACM and then VCM. Closing stock in 2008 under ACM. 2008 closing stock, we have 496.4. So here will be 496.4. Under the variable costing method, same period, 292.4. 292.4. What's the difference? That should be 204. Okay. So difference in closing stock is 204,000. You then find difference in opening stock. For ACM and then variable costing method. Opening stock 2008 for variable ACM absorption costing method. Opening stock, we got 204.4. Here will be 204.4. Then under the variable costing method, 120.4. Here is 120.4. What's the difference?
84.
84. 204 minus 84 will give us 120,000. Let me just complete this. This. It's not correct. All right, sure. Okay. Okay. So this represents difference in stock valuation, which is B. There is B. Okay. So when you look at our calculation in difference in profits, you see that difference in profits and difference in the stock valuation are equal. in the first period. So let's move to the second period quickly. Closing stock in 2009. Closing stock in 77.4. 77.4. Closing stock.
277.4. 277.
Okay, I was wondering. 277. Yeah, that's correct. 277.4. Then under the variable costing method.
163.4.
163.4. What's the difference?
114.
114. 1 that's 11111, right?
Double one.
Sorry,
114.
114. 114. Yeah. Then opening stock. It will be closing stock in the first period, which is 496.4 minus 292.4. That will give us 204. So 114 minus 204, what do you get?
Negative 90.
Pardon?
Negative 90.
Minus 90. So that's that. A is equal to B. The difference in profits in 2008 and 2009 of 120,000 and then negative 90,000 is the same thing as difference in stock valuation in within the same period. All right. So that is the end of the question. Let me know if you have any question on this so that we can close the class. I've delayed you by additional 20 minutes. Sorry about that. So it's better this way. At least in our next class, we are going to be starting afresh with a brand new topic, which is relevant cost for decision making. For this purpose, I will advise you to go ahead, go and read relevant costing. All right, go and read relevant costing. That's what we are going to be doing. We'll spend some minutes or hours to explain the concept. Then we are going to have illustration. We can't complete it. We may likely have about 2 or minimum of 2 periods, a maximum of 3 for the relevant costing. Of course, I will share immediately. Lekon is asking whether you are going to get the material, this working note. Certainly, I will share. Yes, let me know if you have any question for me so that we can close the class. Immediately after this, I will share the working note with you so that you can make up your own notes. Okay. Any question? All right. So in the absence of no further question, I want to say good night to all of you. I will see you next week, Friday, by the grace of God, when we shall be starting a brand new topic, which is relevant cost for decision making, or you call it relevant costing. Good night, everyone.
Good night, sir. Thank you.
Good night, sir. Thank you.
Yeah. Good night.
Thank you, sir. Good night.